What's going on, guys? Welcome back to the channel. Today we're taking a look at Spotify. Now, Spotify's price has hit near 52-week lows. So I thought, you know what? Let's take a look at this company. Let's revisit it because I haven't actually analyzed this company in quite some time. So what I want to do here, folks, is go through the numbers of Spotify, figure out what this company's doing right, what they're doing wrong, and then afterwards figure out the intrinsic value of Spotify using my very own software here to figure out what we should be paying for this company today. Now, if you are new to the channel, what I like to do is use my stock research app, and when I see a company's stock price decrease, to me I get excited. Now here's the thing with Spotify, and why am I getting excited about a stock price that's decreasing? Well, it becomes less risky, right? You're getting pretty much the exact same fundamentals of the business that it was while it was trading at $247. Now it is currently trading at $79. So essentially, I see that as a discount. Now, with Spotify, we are grading this company a 3 out of 10. Now, what does that score mean? Well, with the software here, it takes a look at the company's financial statements, so their cash flow statements, their income statements, their balance sheets, and it grades it out of 10 based off certain criteria if they're hitting certain marks or if they're not hitting certain marks. 3 out of 10 is not a great score, but however, it did score in those three categories, it scored in the best categories, in my opinion, if it had to get that score. And those three categories are net income, the free cash flow growth, as well as the revenue growth. So the net income is going up, the free cash flow is up, as well as the revenue growth is up. And this is over a course of 5 years. This is what we want to see. This is essentially the core fundamentals. Granted, what goes into analyzing companies, taking a look at their debt levels, who's analyzing or who's running the business, and so on and so forth, which we'll go and jump in a little bit. But those three things, that trifecta, is the basis is pretty much the ground basis for any business, right? Because if they're not making money, what are they doing? Now, with that being said, what is Spotify doing right? Well, those three things. And what are they doing wrong? A whole lot. But some of these things are forgivable. The current ratio is currently sitting at 1.31. Now, when I analyze businesses, I want to find companies that have a current ratio of 1.5 or higher. Now, if you're wondering why that is because that essentially indicates the liquidity of their assets compared to their liabilities. I like finding companies that have enough assets on hand to dish out and pay the liabilities in case of uncertain economic times ahead. And I'm a long-term investor, so I want to make sure that that number is consistently solid. 1.5 is great. However, we are at 1.31, just slightly below that. So it's not getting any points from me. And the return on equity is also down, sitting at negative 8.79%. These are just the numbers here, folks. You can want to take a look at this software. I am extremely just a numbers guy. I want to see what the company's done and what they're going to be potentially could do in the future. Negative 8.79% in revenue or ROE is not great. We want to find companies with 15% or higher. A strong ROE is great to have, and this means that the company is obviously has a strong return on equity. EPS growth is down. The debt to equity is extremely high, sitting at 84%, where we want to find companies ideally, personally, at 50% or lower. Some investors want to look at debt to equity with 30% or lower. Now, I like to find 50% or lower because that indicates to me that they're leveraging their capital through equity and not taking on debt. Their share dilution is also up by 1.98%. That means over the last 5 years, they've increased the amount of shares by almost 2%. We want to find companies that are keeping the share count the same, or even better, buying back shares. That just means that you're not sharing as much piece of the pie with everybody else. Sharing is not caring, guys. The thing with Spotify, there's a lot of negative numbers on the board, and we don't want to see that, but granted, it is a somewhat of a new business, so it's somewhat forgivable. The main thing is that what I want to see and what they're actually doing is that they're growing their key fundamentals, and everything else eventually will follow. So for me, when I think about potentially investing into a company like this might be the opportunity. If they're generating positive free cash flow, that means they have enough free cash flow to be actually in the plus, in the positive. They can use that money to pay down any debt that they may have and reinvest back into themselves, do a lot of things. A lot of cash flow negative companies is you're winding up for a lot of trouble. This is what happens when you get into a company too early. When it's just in the infancy stage, there's a lot of red flags that occur. It seems to me, from just looking at what's going on here, that Spotify is at the cusp of breaking through that barrier, and eventually everything in the future will pretty much iron out. Let's find out what the intrinsic value of this business is. We're going to jump into the price analysis section here, and if you're enjoying the video so far, folks, hit that like button and subscribe button. It means a lot to me and a lot to the channel. Now, what this section here does, folks, I can do 3 different assumptions, and I like to use the historic numbers of what the company's shown over the last 10 years, if it's available, and if that data is available, and plug them into these boxes to try to roughly guesstimate what this company should be priced at with my desired return, PE ratio that I think will be at the end of the next 10 years, price to free cash flow, as well as the revenue growth, profit margin, free cash flow margin, and stuff like that. And what I've done here, folks, is I've plugged in those numbers that roughly are in the same vein of what they have historically done. I do believe that they have the potential to grow at 21% a year, granted the size of the company and granted the likeliness of the streaming space based off what it is. Now, I'm going to click calculate. This lovely software is going to figure out what it should be worth. Current price is $79.45. If you want to get your hands on the software, folks, 7-day free trial. Follow the link in the description box below. Something you don't want to miss out on if you want to screen companies quick and understand where they stand. So take a look at this. Average calculation comes out to be $89.68. That's a moderate average of $89. Aggressive average of 124 and a low side of 55. Now, you might say, wow, Spotify is an undervalued company. Here's the one thing, folks, that you have to keep in mind, and that's the profit margin. Yes, our net income, profit margin, it's technically going up. Profit margin is on the negatives. For the last 5 years, it's been a negative 8.43. Currently, it's at negative 1.77. So what I did, folks, was I factored in what happens if they start being positive next year, and they keep a 0.5% profit margin over the next 10 years. Then I did 1, then a 1.5. Obviously, the 0.5 profit margin is extremely low, as well as the free cash flow margin being extremely low as it is. But these are extremely conservative numbers, and with the exception of this profit margin being somewhat speculative, I have to put these numbers in, but I don't think it's in this territory, this moderate and aggressive average. If anything, I think it might be in this conservative numbers. And honestly, if I do 0.3 and get as close to 0 as possible, it's going to obviously bring these numbers down. But you have to anticipate, look, we have no idea how long these numbers are going to be negative for. So that being said, that is in a somewhat of a speculative territory. And take a look at this, folks. Roughly, you're looking at $55 to $52 on the low end, assuming they become profitable the next day. Now, currently, it's at $79.45. So technically, this stock price has a little bit more to fall. So do I like it more now that it's at $79.45? Yes, I do. It's not quite at $52 just yet, but it needs to get down to this price here for me to even call it on a spec play. Ideally, I want to see positive profit margin first before I even jump into this. But the lower this goes, the more better I feel, and I know that I won't be overpaying for a business such as this. I use Spotify on the daily. It's a phenomenal app, but even though I like the app, even though I like the company, I have to make sure I'm paying a proper price for the stock, and that's what I'm trying to do here on the channel, folks. Just find great companies at great prices. Anyways, folks, if you enjoyed the video, if you haven't done so already, hit that like button and subscribe button. I will see you in the next one. Thank you so much for watching.